Well, hello and welcome to Women of Color Money and Legacy, where I talk money matters. I share strategies to empower us to become financially literate in terms of managing our money wisely, making important financial decisions, building generational wealth, and creating a lasting legacy. It is a journey of learning and growing together. And I want to start by welcoming all of my new subscribers. I'm so happy to have you a part of the community. Now, do me a favor and click on that like button. It helps the channel to grow. And if you're new to the channel, I invite you to subscribe. And that being said, let's get started. Now, today I want to talk to you about managing fear during a recession. There is a lot of uncertainty when the economy starts to slump. So I wanted to help calm some of those fears by presenting facts and alternatives to help you to not only survive, but to thrive in the wake of a full-blown recession. Now, unless you have been living on a rock for the past few months, you should be aware that we are in a soft recession in spite of what the government might have you to believe. Consumer goods have increased. The inflation rate is 8.3%, the highest that it's been since the early 1990s. Interest rates have gone up 3 percentage points in the last 6 months, with more rate hikes on the docket for this year as well as on into 2023. So we are in a recession, and the truth of the matter is it is going to get worse before it gets better, because the Fed is aggressively fighting to bring inflation down to a reasonable rate. In the meantime, we as consumers are the ones stuck in the middle to suffer as a result of the Fed's attack on inflation. And we're all just flying blindly here because no one really knows where the economy is going to be in a year or more from now. Even the Fed is uncertain. What we do know for certain is that we have already begun feeling the pinch, and it's only going to intensify. And as we move closer to a full-blown recession, it's going to create even more fear. And the Fed projects that the unemployment rate will increase as more companies start to lay off workers. In fact, 50% of firms surveyed stated that they expect to lay off workers. Investors are already starting to sell off and pull their money out of the stock market. And now that 2-year feeding frenzy in the housing market that catapulted home prices to ridiculously high levels and caused buyers to overpay, now the chickens are coming home to roost. And let's take a look at these 3 areas of imminent fear or concern that people are faced with during the recession and how to manage those fears. The 3 areas that we're going to examine is unemployment, stock market investors, and the housing market. And let's start with unemployment. And in a recession, unemployment tends to increase as companies cut back on staff in order to reduce their expenses. And last week, the Fed projected that unemployment could increase up to 4.4%, which is probably on the conservative side. Now, other economies are projecting unemployment could realistically reach 6% if the Fed expects to get the inflation rate down to that 2% target rate. And the industries that are hardest hit during the recession are retail, restaurants, tourism and travel, leisure and hospitality, real estate, and manufacturing and warehouse. The retail industry makes up 11% of the American workforce with an estimated 15.6 million employees. And in a recession, retail gets hit the hardest in terms of layoffs because people tend to rein in their spending, especially on expensive merchandise and beauty supplies. Another industry that is hit hardest during a recession is the food services industries. Restaurants typically operate on thin margins even in normal times. So during a recession, restaurant and bars tend to take a large hit. And the food services industry employs approximately 12.2 million people. Retail and food services make up the largest employment sectors. And also, travel and hospitality industries are dramatically impacted by a recession. People tend to cut out on travel to save money. Hotels and airline growth stall during a recession as well. And the industries that tend to do well during a recession are healthcare and food. And the tech industry is fairly recession-proof as well. So if you're employed in one of these industries that tend to get hit the hardest during a recession, you definitely want to keep your ears and eyes open, attend those company meetings and ask questions. And you can become proactive by looking for job opportunities in the healthcare, food, or tech industries. Find out what you need to do in order to qualify for employment in these less vulnerable industries during a recession. Now, you're not going to be able to get a college degree in the next 6 months, but there are positions that you don't need a degree in order to qualify for. And as I mentioned last week, with a hard recession looming, you want to prepare a recession plan. And I've already drilled into you the importance of creating an emergency fund, living below your means, and paying off revolving credit cards. But if you have good to excellent credit, you can consolidate those high balance, high interest credit cards by transferring the balance onto a 0% interest credit card for up to 21 months. And you can go to bankrate.com and do a search on 0% interest credit card on balance transfers to get a list of card options. Now let's move on to the stock market. Now, we're seeing a bear market right now, of course, and as I stated earlier, investors are already starting to sell off and pull their money out of the stock market and putting it into money market mutual funds. And that's due to the fear of uncertainty. And if that's your plan of action, that's fine, but that's certainly not my strategy. Now, I'm personally following the Warren Buffett stock market strategy, which is when others are greedy, be fearful, and when others are fearful, be greedy. So what I'm doing is keeping a certain part of my portfolio in cash and EFTs, which are highly liquid. Now, dollar cost averaging is a good approach because you'll get to buy shares as the price declines. And you can dollar cost average using the money in your cash reserve or new money. And this is not the time to invest in highly speculative growth stocks, especially profitless companies. They tend to do worse in a recession. Stay away from companies with high debt loads because they could have trouble servicing their debt if revenues and cash flows decrease. They could also have trouble refinancing that debt after the maturity date. You want to buy high quality stocks like blue chip companies, dividend stocks, and EFTs. These are what's called all-weather businesses. Now, it can be gut-wrenching watching your portfolio bleed during a recession, but remember, it's just the paper loss as long as you don't sell. Now, the stock market has been around for 230 years and been through many crashes, but it has always rebounded, so you can be encouraged by that. Just hold your nose and continue to invest wisely. Now, the Fed just might be doing you a favor and setting you up for millionaire status once the stock market goes back on that bull run. It might take some time, but the stock market is going to bounce back in a big way. Lastly, let's move on to the housing market. The housing market is in a recession. It is slowing down quickly with rising interest rates. For 3 straight months, home sales have fallen. Just last week, the Feds announced another 75-point rate hike. And as you can imagine, the real estate business as a whole has slowed down quite a bit. I heard one mortgage broker describe inflation as an enemy of the housing market. The higher inflation is, the higher rates are going to be. And not surprising, refinancing is down 90%. And if you're looking to buy a house, that's bad news, and it's only going to get worse because there will be more rate hikes to come. Right now, a 15 or 30-year mortgage rate is over 6%, the highest it's been since 2008, and is expected to go above 6% in the coming months. And in some places, it's already over 6%. And let's do a one-year comparison and look at the math. The median home price is $405,000. A year ago, the mortgage payment on a single-family home would have been $1,390. Now, fast forward a year, and that same $405,000 mortgage is now $2,116. That's $726 more with the current interest rate, which is a 52% increase. And that's scary if you're a home buyer because landlords are seizing on this housing market slowdown by skyrocketing rent prices. So you're not getting any breaks if you're looking to rent a home or an apartment and wait out the housing market storm. If you're a seller and looking to sell a house and buy another one, you're also in a catch-22 if, say, you bought your home or your current house at 3%. because now you're looking at a 6 or 7% interest rate on that new house, and that's a lose-lose situation. Now, I thought this was an interesting analysis from Spencer Raskoff, the co-founder of Zillow, which of course is a real estate marketplace. He said that the housing market is worse than most people realize. Although the housing market is slowing down quickly with the increase in interest rate, houses are still selling rather quickly. He attributes this to the fact that there are still limited inventory due to the mortgage rate lock-in. What that means is if you bought your house up to 10 years ago, you probably have a mortgage rate in the 2 to 3% range. You're locked into that rate. And that makes it difficult for you to list your home and buy at 6 or 7% interest rates. Consequently, there are few sellers. There's not much inventory, so those homes are selling quickly. Now, Moody's analyzed the housing market, and they researched over 400 housing markets in the United States and found that 96% of markets are currently overvalued. And here's a list of the top 10 overvalued cities that are in danger of a housing market crash. Starting with the first one, Boise City, and there is overvalued in Boise City at 71.7%. That is ridiculous. And then you have Houston, Texas, that's high, Las Vegas, Ogden, Utah, Fort Myers, Florida, Atlanta, Georgia, Phoenix, Arizona, Charlotte, North Carolina, Provo, Utah, and Lakeland, Florida coming in 10th at 39% being overvalued. Now, Zillow is reporting that the housing market inventory could return to pre-pandemic levels in 2024. In August of 2022, inventory was just under 800,000 active listings compared to August of 2029 when inventory was above 1.3 listings. Of course, we know that the reason home prices skyrocketed 32% over the last 2 years is because inventory fell so low. There was an imbalance in supply and demand. Now, analysts project that we will continue to see a seller's market throughout 2023 as home prices flatline. And that's the national average. That's not specific to your geographic area. You'll have to keep a close watch in your particular market. And no one has a crystal ball to predict with certainty when the housing market is going to turn around. It all boils down to supply and demand. But I wanted to present you with an overview of the housing market to help you to map out the best plan of action over the next couple of years should you find yourself in the position as a buyer, seller, or renter. And personally, as a prospective cash buyer, I plan to wait it out and get the lowest home value that I possibly can. Now, that's going to wrap up my video for today. I hope this information has been of value to you. Now, don't forget to like, share, comment, and subscribe to the channel. And click that notification bell to receive an alert each time I upload a new video. Take care, and I'll talk to you soon.